Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, March 18th, 2020. I want to just get a few things out there, share my thoughts, and cover a few charts in the process. My thoughts are this: as far as the broad market goes, we've reached that point of at least a temporary point, possibly a little bit more lasting point of what's known as seller exhaustion. There is, if you recall, going back a few weeks ago, let me use an example here. A few weeks, a couple months ago, really, talked about Apple and gave you some price targets on Apple on the 60-minute chart where I thought it was heading, down to this trend line. And this was before Apple reported. Apple had a, record quarter, blowout earnings. What's new? That's typically what they do. And I talked about it at the time, both in advance and afterwards. That is, I've seen this many times in the past where a great company has a blowout quarter, blow away expectation, record earnings, all that good stuff. And this one I like to pick on because it's everybody's favorite, and that marks the top. Now remember, Apple had the coronavirus. They did warn before. That kind of was early on in the trend of this market going down when they warned about some of their supply chains being disrupted. But that was over here, if I recall. Either way, right after the earnings, they had that pop. The earnings date was here, but that's after the bell. So there was their all-time high right there on the pop from earnings when the stock opened the next day after they reported the following evening. And that was it. And that pretty much marked the top. It came up, made a double top, and it went down. Now, why is that? And I talked about it at the time because a individual stock or the stock market reaches a point of buyer or seller saturation. So what you get is after an extended bull market with months and months or years of gains, at some point you reach, and it's not a literal point, it's metaphorically, when the last bull has bought his or her last share of stock, there's no one left to buy. If you think of it that way. So, the universe of willing buyers is a fluid universe. There's always some more out there. But for the most part, when, everybody's bullish and everybody's bought, chock full of SPY or QQQ or, S&P index funds or Apple in their 401k and the long-term accounts, that's where a market reaches a point of a buyer exhaustion, and it could be temporary or it could be more lasting. And so where I'm going with that is, recently it seems to me that the stock market, and this is NQ, the Nasdaq 100 futures. I'll show it on QQQ, but you can see it clearly here. This is a daily chart. So these are the last 4 days. It's around that 7,000-ish level right there, a little bit below. I mean, where the ends of those candles have gone to. But each day we seem to be testing and closing below that level. And so, like I keep saying, the fundamentals. Every time I glance a headline, I see things getting worse, not better. But then you have to ask yourself, in a stock, take Apple for example, in that run up to the highs, all-time highs, how much of that blowout quarter has already been priced in by the market, by the majority of market participants? And so right now, ask yourself how much of the 30% drop or so in the market, how much of that, the fact that Marriott's laying off, what did I see? I don't know, 30,000 employees. They're furloughing at least. They're going to stop paying their paychecks, but they're going to give them benefits. Airlines aren't flying hardly anymore. They're down to skeletal crews and flights. Cruise liners aren't sailing. There's some lockdowns in some cities, but how much of that again is already now priced into the market? How much of that was anticipated? So what I'm saying is here, it's not that we cannot go lower. I still think over time we do go lower. It's just that we've reached that near term, at least it seems as of now, and this could change, by the time you get this video, boom, we break these support levels and go down. But it seems to me that the market has reached a point of I'll call it news exhaustion. People, the headlines are doom and gloom, but they've been for a while. But again, they're also, even though if they're worse in the last few days than they were 2 weeks ago, again, the trend was heading that way. And the markets are pretty efficient at pricing things in, not instantaneously, but looking out ahead to the future. So, and where I'm going with this, if you look at the rally today, QQQ off the lows when the market opened, This is the opening right here. This is the low. Here's your opening line right there. I don't know if you can see the shade. That's the 930 mark. And we rallied 5%. The market gapped down because the futures, and again, get used to that. It's the new norm now, these 5%. We even hit the 5% up limit in the futures the other night too. And last night we hit the 5% down limit. So the futures get locked, and it's almost a common occurrence now. And so therefore there was really nothing to report. I wanted to see how the market went today, and there it is, 4.94. So 5% pop. And if you're wondering, man, how do these futures go from lock limit down all night? This you're not seeing it here. This is QQQ to a rallying 5% at the open. Now they're still down 3.5%. So I'm not trying to spin this as positive. I'm just trying to spin it for what it is, and I'm going to give you my thoughts real quick right here. This is the point where I like to kind of step back. It's been a real nice run on the downside. We've had a lot of profitable trades on the site officially. I've had a lot personally. And this is a point where I kind of I lighten up on position size, and I lighten up also on my personal trades and those on the site. Right now, as I start the video, we just had that the USO trade. I threw it out there as a speculative trade, aggressive trade. I thought the risk reward was favorable with that tight stop I put on. We were stopped out for effectively a 1.6% loss when you factor in the beta adjustment, meaning I suggested a 0.6% or 0.6% of a normal position size. So when you factor that in, total loss was 2.7%, and that equates to a 1.6% loss. I will take those trades all day long. I'll get to USO in a second, but other than that, right now we have only 2 official trades on the site that are active. We have gold, and we have the short on LQD. I'll get to those in a second as well. And when I look at QQQ, like I said, I do think it's going lower. I gave you some levels that could trigger the next, spark the next wave of selling. Let's get to that. Let's stay on indexes while we're here. This chart, this is the one I'm watching. This paints a better picture than QQQ. That's why you see a lot of futures charts from me. I do like to watch both. They're both very significant. So now we have 4. Yesterday we had 3, and in the last post that I put on the homepage yesterday with chart images, I said this is this is an important level, this R1S1, but this is the most important level right now on the in the markets, in my opinion, and that's at 69.50ish, give or take. You can see now 4 distinct reactions to help validate. Very important level. So what it tells us is, you have the bullish divergence right now. Divergences are not the be-all end-all, but they are quite often a pretty accurate predictor of an impending trend reversal. And so I can't tell you which way this breaks. I can say if that level goes, and it's anything more than a whipsaw, and that's what I'm trying to say. It's tricky right now, and that's also why I might not be as eager to short a break of 69.47 or these recent lows as I would have and was back here. Breaks of support down along the way or rallies back into resistance, because again, the stock market's down 30% in just a matter of a month or so, and although it's probably heading lower, the risk reward rapidly diminishes when you're that oversold. And like I said, maybe it's be who knows what the catalyst could be, such as a short ban on shorting, things like that can spark an explosive rally. So like I said, to just loop back to what I was saying, it's been a nice run. It's not over. Believe me, I'm scanning the charts continually, looking for objective trades, trade ideas, way to get way to make some money. And until we have a what looks like a bottom, or at least a tradable uptrend, all long side trades, and even a lot of the short trades will be hit and run trades, meaning get in, get out quick, like that. That's what that USO was intended for, and I'll get to that in a second. So that's it. At this point, we are sandwiched between support and resistance. Remember R1 yesterday? I turned it into R1S1, meaning resistance, support. Or if you're above it, it's support. If you're below it, it's resistance. TA 101 right here. The market opened up, kissed those recent lows after the there was your lock limit down. I don't know if you can see it there, a little purple line all night, and boom, fell to support. That was an opportunity to go long, and then boom, right into resistance. So if nothing else, and I say this often during corrections, bear markets, technical analysis shines, because that's what traders are. Fundamentals are changing. It takes a while to really digest what a fundamental impact a shutdown a company or pulling their sales force out of the field will have. But traders can instantly look at the charts, and even if it's not humans or algos too, algorithmic trading programs looking at these levels. So there it is. I talk about my thoughts. Kind of keep it light right now. If we take out R1S1, then and these divergences stay intact. Even if we get another low, I'd almost be surprised if they didn't pop this low right now. And I'm saying I talk about it's kind of personifying nefarious forces in the market, such as those algorithmic trading programs that will look and see, okay, where are all the stop clusters? And, we're Goldman Sachs or we're whoever, and we have a large trading desk with a lot of capital, and we can pop these futures, sell them, get them to come down there, pop those stops, see a big flush out move, and then we turn around, go long, and turn the machines on to buy, and then ramp it back up there. So that's a possibility. I just don't like it right now. So I just want to let you know that it could go either way here. You have the bullish divergences, maybe they play out, maybe they don't play out, and maybe if they do play out, maybe you get that washout move and then they play out and they're still here. As long as you're above these previous lows, you still have the positive divergence. So what I'm trying to say is the risk reward to shorting, adding new short positions now just is not very favorable. There might be another 10% downside in this market or more. But there's also the risk of a very sharp reversal when you're this oversold, and you have this potential bullish technical developments right here. And right now there's really no trade because you're in what I call technical no man's land, smack between support and resistance. And again, we take that out, then it opens up the door to that target there. We take that out if it's anything other than a brief whipsaw, and then we recover it. And so if you want to short a break of the recent lows, what you do is you short it and you put a stop a little bit above the where the breakdown point was, because if they do reverse it, that could be a pretty bullish event. All right, that's enough on that, and let's get away from the indexes, or at least the futures. I'll touch on QQQ and SPY because I know a lot of you trade that. Again, this is what it looks like on the daily time frame, and we were able to sidestep a lot of this noise and that big rally yesterday by closing out our our official QQQ short trade. And so basically right now the market's spinning its wheels. Very active traders can game these levels, not on the daily. I'd focus on the intraday charts. Swing traders might as well just sit back and wait for the next objective, higher probability entry in the on the index ETFs. All right, so that's the daily chart. That's what it looks like. And lately I've been focused on this 30-minute chart, QQQ. There's R1, resistance 1, which is really R1S1 at this point in time, because above it, it is when prices are below it, it's resistance. When they're above it, it's support, like it was yesterday. Broke down, gap down tonight, and there's same story. If you're a QQQ trader, you could have, if you were long or took a long this morning, you could have then rallied up, waited till that level was hit, and then closed your long. You could also shorted there. Right now you're a little far from it, but again, it's like noise. You don't want to. This is where swing trading, you get grind up right here, and that's why we were short on the way down, and we covered over here, and that's fine. We sidestepped this mess right now on that recent QQQ short trade. Remember, these are just unofficial trades because I don't have the confidence to add these on as and they're expected to be very short-term trades too. Typical the official trades on right side of the chart are swing trade ideas or longer-term trend trades. And yes, some of these trades we might be in and out quick within a day or two here, as I spoke about, because the markets, like these trends are, like the market on the fast forward button on max speed right now. You get these 10% counter trend rallies. You rallied here 10% over 10 in just three, from the lows on that trading session, 2 trading sessions later, that was it. It was the end of the run, about 11% pop. And then boom, there was your next trend. So it could take normally months to make 10% in the stock market. Here we can make it in a few days. So right now, Chop City, charts still don't look good, long-term charts especially, but let's go over to SPY, and then I'll get to the other stuff for you. SPY, same story. Divergences. Divergences are not the be-all, end-all, but they're just a heads up that there's a potential catalyst for a rally. And again, what would cause that? If you're thinking, man, I get a phone call from friends, family, and they're just, that's probably the biggest source of my news. I kind of don't really turn on the TV and watch that stuff much. I've been just sitting in this chair for, oh gosh, well over 12 hours a day for the last couple of weeks, and just bearing my head into the charts, and I'll get the headlines from various sources online. But that's it. SPY, potential divergence in a downtrend, make no mistake about it. But again, the risk reward for shorting or staying short here just isn't great in my opinion. Doesn't mean the market can't go down, just not my kind of trade. I like the higher probability stuff. All right, so let's talk about that. This one wasn't high probability. I mentioned it as a catch a falling knife trade. So I try to clarify, or state my thoughts on each trade. They're all, a lot of them are different. Most of those are the higher probability trades. This was a catch a falling knife trade, as I said, aggressive. Take it if you like, pass if it's not your cup of tea. What I was expecting and hoping for was a positive reaction to the weekly inventory report that came out today at 10:30. We didn't have an initial knee-jerk reaction, but we just gradually started going lower from there. So that was stopped out. And what I'm going to do today after this video is I'm going to catch up, clean up the old trade ideas, like this one, for example. Post an update that it was stopped out. Always post an update with the percentage gain or loss when a trade hits a final price target or the maximum stop. And again, on this one, like I said, from where we entered, entry price when it was posted was at on that chart was 511, stopped out at 497. That's a total loss of 2.7 when you then factor in the 6/10 beta adjusted position size of 1.6% loss. So to risk one, or let's just not factor in the beta adjustment, to risk 2.7% to make. I was going to add this target if it went. I was going to add a second target here, but we got stopped out first. That first target was at 13%. So to me, that's an attractive risk-reward ratio. It's about a 4-to-1, risking about $1 to make $4. And again, I'll take them all day long, especially when I keep the stops tight and small. Get in, get out quick with minimal damage if the trade moves against you. So that one is completed, and I will certainly keep an eye on it. I'll tell you right now, Crude futures, I posted a chart of CL in the trading room below. This is what I call potential divergence, not confirmed. This is a 60-minute chart. I use a term potential divergence when the momentum indicators are still heading lower, because you're in a downtrend and you could certainly continue lower. That's what made it an aggressive catch a falling knife trade. PPO is pointed down, RSI is pointed down. To me, the divergence is confirmed when the PPO makes a bullish crossover, because that then effectively will give you a higher low versus the previous low. So when these indicators, if and when they turn back up, you'll have confirmed divergence. That alone is not a buy signal, but what I'll be on the lookout for is a potential buy signal, something like maybe a big bullish engulfing candlestick or 2-3 candlestick pattern, anything like that that might indicate a reversal. But right now, there's really no support here. And crude oil, obviously demand's falling off a cliff. Planes aren't flying right now. Cruise ships aren't sailing, and that's and everyone with the lockdown and all that, people aren't or won't be driving around as much. I'd say the lockdown, some cities, I heard that San Francisco, somebody told me that they did, and New York's talking about it. I don't know if that's going to happen or not. Okay, so the two current active trades on the site right now that we're still in, we have a long on gold. The basis on that trade was to go long on this 130, off this 136.37 support, which is so far held. We've got our stop right here. I'll roll that back, and there's the word stop. And there we go. There's our stop loss if it's hit. And as I said, if gold, did put in a divergent high, there was quite a bit of negative technicals, that foreshadowed this drop. That's pretty solid support there, and even better support. And I can't rule it out. And if we get it and we are stopped out, I will almost certainly be going long here. I talked about this level before, about 130 or so on gold, a big support level, and also trend line support there as well. So there's that potential there. And like any trade, this one either works out or it doesn't. But I told you that is the even better buy point than 136.58. But being that gold is in a larger bull market and we had a heck of correction, sometimes you don't get what you want on the pullbacks. In a bull market, a security will hit a support level, and maybe that's it. So like I said, I thought it was, kind of did the math and said, what, feel better stepping in there instead of trying to wait for a move all the way down here to this uptrend line in that 130-ish, 132 level, and risk missing a reversal in the next trend up, because I do, again, I made it clear many times, gold's in a bull market. You can see this uptrend. So we'll just, really nothing much to update on that today. I look at the charts. We went up and we hit our, where was it? Our second price target. I had it right here. We already hit our second price target, and that gave active traders an opportunity to get out, take profits, or those that were only targeting T2. But we still have this third additional target, and I will, if we get anywhere close to that, I will almost certainly be adding more targets, letting that run as a trend trade. If we get close to T3. All right, LQD. The LQD corporate bond ETF. This is one of our active trades. We closed it out here. We recently caught the bulk of that move down. Shorted right here. The trend line the day before it broke down. Got in front of it. Closed it out there. Averted that big bounce. Get back in profits, and then we re-shorted it right here when it bounced back to that former. These are the former targets. That's why I have them kind of dimmed down a little bit. This is the sole target here. This was our entry, and we're getting close. So as I said, I've updated this one quite a bit recently, of course, because it's now only one of the two active trades. Because like I said, I think we're in a win-win situation. Yesterday was a great example of that. So you had a strong rally in the stock market yesterday, right? We were up, what was it, over about 6% at one time, and yet LQD was down. Now here the stock market's down big today. Whatever I just covered, and yet you have LQD down again. So this is I love this trade. You don't get a lot of these very often where it's win-win. Most of the trades are either going to go in line with the stock market, or if you're going long or short a risk-off asset like treasuries or gold, they're working inversely. So in this case, so far, at least the last couple of days, my theory that it's kind of a win-win trade has panned out for that fact. Market's been up. LQD was down yesterday. Market's down today. LQD is still down for the reasons I said before. Risk of more and more of those bonds being downgraded to from investment grade to junk status, and then having to be jettisoned out or sold out of this portfolio. Okay, and somebody did ask me yesterday, and I told them I'd try to, as soon as possible, get back to them on that and do an update on the miners. I can't do an extensive update here because it entails me going through a lot of the largest names. Again, looking at gold. I'm watching them, and I will, as soon as possible, put an update. I need to go through the individual charts a little bit more. The big names like Newmont, Barrick. All the bigger gold mining stocks, and I will do that soon. Just kind of give you an idea where the sector's at, because birds of a feather flock together. I can tell you the components of GDX are highly correlated. So you want to look at the chart. You know, the words, if you're going to, if you can't make a strong case to go long GDX, you know, if you look like GDX is going to drop, then you don't want to go long Newmont because it's probably going to fall along with it. So what I'm seeing here is we had like gold recently, you put in a big divergent high, negative divergence. That was a catalyst for this correction. I get this question all the time, so it bears repeating. People get confused on the site. They don't understand someday why gold's up, and it's also a reason why we're long gold right now and not GDX. In the past, and many times, I've added GDX or Nugget or Dust as the official proxies when I'm bullish on gold or bearish on gold, because as I've said in the past many times, GDX or the gold mining stocks are simply a leveraged play on gold. I promise you can go back, take any chart, you can use the Huey index if you want, it goes back many years, and overlay it with gold. What you will see is when gold is in a bullish trend, uptrend, the mining stocks go up, whatever gold goes up in percentage terms, times a factor of whatever it is, 2, sometimes 2 or even 3%. And likewise, when gold falls, the mining stocks will fall more than gold, and I'm talking the major trends, and that's a correlation that is typically in place at most points in time. The reason is very simple. Just like talk about the energy stocks, oil producers, think about a gold producer. They have fixed costs. They don't pay their employees anymore to wake up in the morning and show up to work and go run the machineries and dig. So it costs, you know, freezing everything else. You know, they still have their overhead expenses, rents, you know, leases, all that kind of stuff. But when the price of gold, let's say, doubles, you know, from 1,000 an ounce to 2,000 ounce, that's just a windfall for these miners, because they're, you know, again, the cost to pull it out of the ground is not much the same. It's pretty much a fixed cost, not a variable cost. So when the, you know, the commodity they're pulling out doubles in price, their profits soar. That's why you have that relationship, and you see it with energy stocks too. You know, when the price of oil soars, you know, the fixed costs remain the same, but their profits are it's a boon on their profits, and vice versa when it drops. So now, where I'm going with that is, and this, I didn't answer the question, I wanted to prelude that. The question I get all the time is when during bear markets and strong corrections and you know, impulsive moves down in the stock market, what happens is gold stocks tend to go down even when gold is going up, and people don't understand that. Why is gold rallying and GDX is down? Well, it's simple. Gold is not a stock. Gold doesn't have shareholders. It doesn't have a CEO. Doesn't have earnings and all that stuff. Gold is a commodity and a precious metal. Whereas GDX and all these companies, they're stocks. That's what they are. They're individual stocks. So they're going to get sold down with the market quite often in those panic sell-offs. And you know, they have balance sheets and things like that, where if the economy really tanks, you know, they may be in, some of them may be in jeopardy as well. But ultimately, longer term, they will follow the metal. So I just wanted to get that out there, and, you know, help you understand why right now, you know, my analysis, my focus has been on gold, the metal, because that is the flight to safety asset. We have treasury bonds, or we have gold, or the two main flight to safety assets that people usually flock to. So right now, like I said, I think it's worth having gold. It's had a nice correction, and maybe if the time is right, the mining stocks. Again, I'll revisit that, but I just want to show you. You can see this chart, big correction, overshot like everything always does, but they snap back, but they rallied right into resistance. I have a trend line right there, or price resistance, I'm sorry, and right above there, and trend line resistance. Here, I'll show it to you on another board. So you can see the back test of the trend line. So TA 101 says no. If anything, you short the miners here. You don't go long. I just want to point that out. What I mean by that is you have a breakdown of a well-defined trend line, a kickback rally to resistance. Excuse me, a little bit of a momentum-fueled overshoot there, but you know, we're just below it now, and so why I don't care to short the miners right now, especially being that I'm long gold. I just want to say that, you know, might need a little work, and my comfort level isn't very high. Here's another view there. You know, had some pretty good resistance up here. So the miners are in a kind of a quirky or precarious technical posture, and like I said, I'd rather just not. I'd rather stand aside that trade right now and have a little more confidence before we go into it. So that's my thoughts on the miners. And I figured I'd touch on Bitcoin. At times I'm very actively posting. We had a lot of quite a few very successful and profitable trades on Bitcoin earlier this year, and even those are official trades. Even the unofficial trades have made some great calls and over the years in Bitcoin. It trades very well to the technicals, and I'm just kind of looking at this, adding levels. These are Bitcoin futures. I just wanted to say too that I'm watching it, looking at it here. There's a little bit of resistance there. It broke this uptrend line and it had plummeled down here. You can see that 44.96-ish support right here you had, and I pointed it back. I believe I pointed that out at the time. We had an ascending triangle pattern right here. And we broke out at that point, and that was that rip in Bitcoin, and then it put in a divergent high. That was a divergent high there. You can see there. Now I'll draw it out here. I'm not using a line tool, I have a box tool here, but that's your negative divergence from that point to that point. That set that trend, and then boom, broke the trend line, and this tells you how well it trades the technicals. A lot of people were looking at that trend line. It was pretty obvious, and once it broke, bottom fell out. But we fell to support. Now, are we flagging here? Maybe that is. Bitcoin is, I'll call it a quasi proxy, a flight to safety proxy, because people, the whole lure to the big, I don't know if there's a term, for the Bitcoiners, those that love cryptocurrency and believe in this. It was an alternative to the fiat currencies, and maybe we'll get that. Maybe we'll get that bid, but technically it doesn't look great, although it is above support. So I can just say that. If you like Bitcoin, you buy it. There's key support right there. There was a reaction low a little bit below, but this could be a little bearish pennant that's the move down, flagging. We dropped down. I wanted to cover it for you, but again, I don't have the confidence right now to step in and buy Bitcoin. And then we used for the official trades, I'll use this proxy right here. GBTC, Grayscale Bitcoin Trust. It tracks the price of Bitcoin, and it also fell to pretty good support. There was that breakout right there again, talked about back at the time. Nice resistance there, broke out and rallied, and that's it. So we fell back to that support level. That may have been it was good for a bounce trade, but we're kind of sandwiched between support and resistance on Bitcoin. Minor resistance there, much more significant resistance up there, and good support right there. So not so good if Bitcoin breaks that support. But again, if you like it, you can go long there and try to hold it for a move back up here or more. I just can't make a strong enough case to buy it from what I see in the charts. I just wanted to update it for you guys and gals that do track or may own some Bitcoin. Coffee. Somebody asked me to update coffee, and Joe, I've been mostly bullish on coffee, but long and short. There's been a lot of pullback trades, but coffee is one that it may have put in a decent bottom, and it's for now you can see it's kind of been hanging above. These are coffee futures. I'll get to JO in a second. We had a long trade, a couple of them. Some were official, some unofficial. I can't remember all of them, but you can see these divergent lows right there, and we did just put in most recently, and I need to mark it up here, divergent low right here. From this point, so I got to draw it here. There's your divergent line. Boom. That was a catalyst for this rally, but we ran into resistance at 112-ish level. Brief momentum fueled overshoot, then we pulled back down below it, and we're back testing this downtrend line right now. If you're seeing, I'm just going to point something out because sometimes people see this and ask me, hey, Randy, is that a head and shoulders pattern? It sure looks like one, but head and shoulders are topping patterns, not bottoming patterns. Bottoming patterns, you have a thing called an inverse head and shoulders pattern. It looks like this. There's your neckline. That comes after an extended downtrend leading up to it, and then you look for a breakout above the neckline as your bicycle. So no, that's just, sometimes we all see what we want to see, and head and shoulders are some of the most obvious patterns out there, but no, I don't believe that's what it is. It doesn't mean now same net effect if we break the lows, which would be, if you want to draw a neckline on that pattern, something like this, and it really doesn't come in, that shoulder never touches down here either way, so you don't have the nice symmetry. But if you were to draw a head and shoulders out of this one, you'd have to use this neckline like this, downward sloping neckline there, and then that would be a trigger on a breakdown of the pattern. But what I was saying, it has the same net effect because these are the recent lows. They're very important. So if those lows are taken out, then that would be bearish. But as of now, if I had to be one of the two, probably long coffee based on that big divergence we have right there. And let me show you JO. And again, coffee commodities, and I think people are going to start probably flocking a little bit more to commodities. They've been in a vicious bear market for many years now. They're beat down, and the thing about commodities is, if anything, everything going on with coronavirus should benefit those. If you have the trucks aren't moving, people are, there's some shutdowns around there, and then you have shortages or prices go up because you're not producing as much of these commodities, and they're still every bit in demand. If nothing else, people are going to drink more coffee if they're locked in their house for the next month than less coffee. So things like that, and again, soybeans, wheat, and all that kind of stuff. So this daily chart's a mess. It shows other previous trades, but here, let me turn all the lines off and just show you the salient points on this chart, which would be, this is JO. Remember, JO is the ETN. It does a pretty good job, but not a perfect job of tracking coffee, but a good job. I like it, and I'll use it as a proxy, both personally and as always on the trade ideas on the site, because futures are never official trades, because I know a lot of people don't trade futures. Personally, I like to trade, KC, coffee, futures over Joe, but I will in IRAs sometimes buy this, although now a lot of IRAs don't let you buy it anymore because it's an ETN. Anyway, that's a whole other thing there. So that's it. Support. It's rallied off support. You would have done well to buy coffee every time it came down to around this level, and that was the story back then. The big question is, are we going to continue up, take out this high? That would be your first resistance level, and then you have a major reaction high here. So coffee could be in a multi-year basing pattern right here, or at least a year-long or so basing pattern. I tend to believe that is most likely the case. And again, I'm going to stop the video here because I could talk on commodities all day long, and I probably should do that. I probably should do a separate update, as I like to do from time to time, on the rest of the agricultural commodities. Look at the metals, industrial metals, things like that have been beat down. Timber's gotten taken to the woodshed lately, no pun intended, as it should be. They're gonna it's gonna put a dent in home building and stuff like that. All right, we'll wrap it up here, guys. And like I said, the theme of this video is maybe keep it light right now. There's times to actively engage the market, and I'm scanning hard for trade ideas. We took a shot at that USO trade today, didn't pan out. But again, if I see something like that, I'll add it back, and I'll try to make clear whether they're just quick trades, whether they're aggressive trades, or whether they're longer term trend trades, and maybe find at some point when we look like we're going to see a decent multi-week or multi-month rally in the markets, then I might look for some income producing growth and income trade ideas as well. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.